Welcome to Cooking the Books. I'm Frances Cook. We all know that house prices are soaring, making it harder than ever to scrape a deposit together. The trick is, when you're talking to a bank, getting approved for a mortgage isn't a black and white process. The bank actually does have a little bit of discretion, just not much. They're charged with making sure they don't give you so much debt that it crushes you, which means if you can show that you're a financially safe pair of hands, they might let you through with a smaller deposit than others. It's all about speaking the bank's love language. So, what can you do to stand out from the herd?
News Talk ZB presents Cooking the Books with Frances Cook.
I'm joined now by Rupert Goff from Mortgage Lab. Now, it's obviously quite difficult for people these days getting a house deposit together, and particularly for first home buyers, getting over that line tricky. So first of all, when you'll be living there, you're going to be an owner occupier. How much are you meant to have as a deposit? And will the bank bend on that at all?
So the ideal amount that you want is 20%. That's what the ideal amount that the bank wants is 20%. So if you've got that amount, then it really comes down, that amount or more, then it really comes down to income. How much do you earn enough to get what you need to borrow? If you've got between 10 and 20%, you just need to reach a little bit higher threshold of income to get that money, because you're a little bit more of a risk. If you don't pay your mortgage, the bank has a risk of not being able to sell the property for 85% of what they bought it for. So that is the risk. Now, so the answer really is minimum of 10% deposit, better to have 20%. So that's the key rule. With the LVR restrictions that have just come in, the bank only has a limited amount of money to give to people under 20%, with under 20% deposit. So they're choosing the best applicants they can.
Yeah, so if you're aiming for that 10% range-ish, 10 or somewhere in the teens, then it can be tricky, right? They don't have to say yes, they may very well say no. Looking financially healthier, that can swing the odds in your favor, right?
Hugely, yeah. And the number one thing is secondary debt. That is, how many credit cards do you have? What are their limits? What have you got in overdrafts? What have you got in those? I don't want to say a brand name because I don't want to pick on them, but those kind of fortnightly, 4-time payments kind of arrangements. Just how do you deal with debt as a person? And are you likely to get more debt after you've got your mortgage, which puts the bank at risk? So that's probably one thing they look at first. That's a clean financial statement of position if you haven't got any of those.
It's interesting, right, with the debts, even if, and I think this takes a lot of people by surprise, that even if you're not using those debt avenues right now, what they see is your debt potential, the debt avenues you have in your name that you could use and run up at any time. Those really count against you. And I've heard all sorts of different numbers, so I'd like to get some clarity from you on this. I've heard things like a $10,000 credit card can mean they assess you as $50,000 more liability. How does that work?
Yeah, that is about right. So I think it's about $46,000. To go back, so that the really infuriating thing for people that have, say, a $10,000 credit card and pay it off every month, they might only use $1,000, is that the bank still judges them the same way as someone who has $10,000 owing consistently every month.
So rough.
Well, it is rough, except that just recently I bought a house as well, and I spent a ton of money going out to get new furniture that looks right in the house. And it was just, it's tempting, right? So you've got that limit there. So the bank has to assume that in the excitement of buying your new home, you've got an available limit there, you're going to max it out and have to pay the 3% minimum payment that credit cards require. That brings us on to why it's so much more money than a mortgage, because 3% times 12, sorry, because 3% times 12 months is 36%, whereas a mortgage is only 9%. So, and that kind of is why a $10,000 limit maxed out is about $46,000 of a mortgage that it cuts you out from. So That's kind of why it is. Look, it is insulting to people who pay off their credit card religiously, but at the end of the day, you could max it out and have that additional requirement of payment, as well as a new mortgage. The bank has to be careful.
Yeah, yeah. And this is the thing. They are right in a way that you've got that open and you could, without checking in with anyone, run it up at any time. And then, it's a bit like dating someone, right? They don't want you to have all these other debt options. They want to be your one and only debt source, really.
One and only credit card. Yeah.
Yeah, exactly. What about, so if you're dealing with that, I mean, I know people like credit cards. I mean, they make life a bit easier. Sometimes you've got reward points or whatever. But also, credit scores, things like that, it can factor in. So is it that sort of as you come close to the mortgage application process, you could cancel it, or you could reduce the limit? What's a good way to deal?
It really is the limit on the day that you apply. So if you've got $20,000 worth of credit cards, you don't really need them. You can reduce them, to $2,000, and that clears up a whole lot of available mortgage for you to get, but still gets you that opportunity to get air points. We all want to, fly to Raro for free or something. So you could have a minimum credit card that you're willing to accept, and give it to give enough to the bank to free up the available funds for them. So it is just prior to you applying. You can even get a condition on your pre-approval that says if you reduce your limit to $5,000, we'll give you the amount of money that you've requested. But it's always better just to show that you're ahead of the curve and presenting yourself in the best way.
Now, you mentioned income earlier, and that's what I want to come back to, because this is actually one that I only recently became aware of myself. I've always been fairly lucky in terms of I've just got a full-time job. It's pretty easy. My salary is my salary. It's done. Banks love that. It's very certain. For people who can sometimes earn quite a bit through commission-based jobs, or they freelance, can that be a problem for banks?
Well, it's not so much a problem. It's more that if an income fluctuates in terms of commission or bonus or contractor, then they just want to see a history of how you've earned that. Now, that's a little bit frustrating for people that have suddenly gone into a high commission role, know they're going to get it because they're selling, easy things to sell. But haven't got a history of it. You really need to think of anything like that as a self-employed income. So anyone who's self-employed has to show 2 years of financials. Here's how the business goes, and here's what we earn. And commissions and bonuses are pretty much the same. There are one or two banks that will sometimes take a year or something like that if it's regular, but essentially you need to show a history. So if you've recently moved into that kind of a role, they'll take the baseline, and then you might struggle to get that sort of commission payment signed off if it's relatively new.
Is there any way around that, or is it just waiting it out?
Well, there is if you are a widget salesman for another company, and you've moved to a new widget maker and are still in the same kind of role, they will often take that. You haven't got that steep learning curve of what's this new industry about, how do I sell it. You can say, look, at the last place I had this arrangement and I got X amount of dollars, and I've moved to this new place, here's why, and I predict I'm going to earn this much money here. So if it's new role in the same industry, and this happens with contractors all the time, right? Otherwise, project managers would just never get a mortgage. So they can say, I'm a project manager and it's a new role, but I've done this for 10 years. And so that's why. So it doesn't have to be 2 years in the same role. It needs to be sort of 2 years in the same industry.
Well, that makes a lot of sense. Is there anything else you can do that sort of boosts your, let's focus on the positive side for now, things you can do that make you look like a good applicant to the banks, cleaning up that dating profile so that they look at you and go, oh, yes, we'll take a chance on them.
Yeah. So, the first thing I always look at is your deposit and how you got it, right? So that because that's a really clear line in the sand is if you've got 10% of what you want to buy or 20% if you want to buy, then I can measure that pretty easily, and I can see you've saved it. You can actually get obviously a gift from Bank of Mum and Dad, but you need to have saved at least 5% of the purchase of the property on your own through KiwiSaver or savings. So that's a really easy first measure. After that, it's really about your expenses. So how are you dealing with the money that's coming in? And look, we all like to, go to the movies and buy some Uber Eats on a stressful night or something, and that's fine. But is it regular? Are you in control of your money? And can the bank see that? And they're looking at 3 months. So if you aren't in control a little bit at the moment, then definitely take a few months to clean it up, really nail down the leftover money into your savings account, and that will present a clean option. One thing that's really good, there's a ton of budgeting apps these days. Plug in the amount that you get in on a fortnightly or monthly basis, or however you get paid, take out your expenses and just see what you should have left over. And if you don't have that amount, just kind of figure out where it's going. It might be to coffees every morning at the local cafe, and that's fine if you've still got a lot of additional money left over, but figure out where the money is leaking from, because the bank goes through your expenses line by line these days. And they call it uncommitted monthly income, but essentially what it is leftover money after your expenses.
Yeah, put yourself into a 3-month money lockdown. Pretend that we're all back in level 4, which I know I spent a lot of money at the supermarket, but that was all I was spending. And all of a sudden I had all this extra cash, and I thought, I thought I was good at budgeting, but turns out.
Unexpected flour and toilet paper purchases.
Exactly. And I do think as well, we've sort of mentioned this 3 months before on the show, and the idea of, if you really want that morning coffee and it's the high point of your day, you love starting your day off, nipping in, seeing your barista, you know each other by name, they start making your order when you walk in there, and you have the money for it, which is also key. But if it's a high point of your day and you do have the money for it, you can always take out some spending money in cash for the week. It doesn't leave quite as much of a paper trail. And if the bank questions it, you can say, I'm doing the cash system for budgeting to keep myself on track. And the thing is, you're not even lying, because when you use cash to pay for things, it's different in your brain. Our brains process more of a pain point for it. So you actually do end up weighing more if you want to hand over that cash. So putting yourself on a cash diet can be a real 2-for-1 kind of hit for that 3 months, right?
Yeah, I think it's important to use the budgeting method that suits your psychology, right? So I am a bit clumsy with things and lose things. So the cash method doesn't work for me. The way I do it is I transfer it to another bank account. So I get my $80 per week and I can spend on that. And when the FPOS card says declined, then I've run out of money and that's it. So it's the same thing, right? It's just getting out your money and paying for it. So yeah, but whatever works for you, do it. The cash method works quite well if you are a responsible person.
As long as we don't have another COVID outbreak as well.
That's right. Yeah.
I did mention the cash method on my social media one time, and I had all these people from America being like, well, that doesn't work. I was like, well, yeah, don't do it there.
That's right. Yeah. Disgusting.
Yeah. Just stick with contactless, guys, until we've all got the vaccine. The other thing you mentioned there, and I'd like to touch on this more because I think this can catch people out, because if you're lucky enough to have parents who have some equity in their home or some cash that can help you towards your deposit, wonderful. I think I know it's not fair to everyone, but also the thing is, it doesn't help anyone else by not using the resources at your disposal. You can try to help other people while still helping yourself. And yet the bank will still want to see, right, that you've saved 5% of that deposit yourself, because they want to be sure that you're a good financial bet, because at the end of the day, you're the one who's responsible for that money. But they count KiwiSaver as your own savings, right? You can just use KiwiSaver.
Yeah. Yeah, that's right. So KiwiSaver and the including the amount from the employer. So because as you know, you put in 3% into KiwiSaver, your employer puts in 3% minus tax, and they actually count that as a total amount of your savings because you've made the effort to lock in that money into KiwiSaver. So you can't access it. So you're taking a little bit of a risk there that you're not going to need to liquidate that money, but that counts. So that's a really good way to save for sure. But yeah, they really want 5%. And as you say, it's because they want you to show that, you just didn't just sort of mess around with your money and suddenly parents have given you 10 or 20%. And that's a fair enough request. And I think we were talking recently about showing that your rent plus your savings equals your future mortgage at 7%, because that's what the bank tests it at. So if you're going to borrow $800,000, they're going to say, well, what's that at principal and interest? So paying it down, not just interest only, at 7%. I don't know what that is. I should have figured that out beforehand. Sorry. 7%.
Maths.
Yeah, I know. Yeah. And what are they paying in rent and saving? And is that enough to pay a 7% mortgage? And I think we could get into the 7%, why it's 7%, and in terms of just protecting that client from future interest rate rises. That's why the bank asks for 7%. But the key takeaway is, what are you paying in rent? Plus what are you saving? Is that enough to cover your new mortgage at 7%? That's a really good way. If you can show that, the bank is always super stoked because you're going to be building the deposit. You're obviously in control of your expenses, and you're a really good candidate at that.
Yeah. And I think that sort of that affordability test is another one that can catch people out. With prices so crazy, a lot of people might, they might have got their deposit together. Well done. That's a huge achievement. And then they might have, maybe gone to an online mortgage calculator and seen, okay, so rates are 2 point whatever percent today. And, tap in, this is how much mortgage I'll want, and this is how much it'll cost me a week. Okay. Oh, that's a little tight, but I can do it. And then you go to the bank and they say no, because they are assessing you based on, well, interest rates at some point in the next 30 years are going to go up, and they want to make sure that you can still pay that. That can catch people out, right?
Yeah. One thing I will say, just to try and make a positive spin on this, is that if you are close, so if you're earning $70,000 and the bank says, well, not quite there, but you're pretty close, what you need to understand is that any additional money that you earn, any bonuses, or not bonuses, but any pay rises, all go to your mortgage, because they've already taken out your expenses and your day-to-day living costs and things like that. So another $10,000 in your income, let's say that's $7,000 and after tax income. And so that's roughly at 7%, it's about $80,000 of mortgage, very back of the envelope calculation there, but another $10,000 of income gets you kind of another $80,000 of mortgage, because it all goes to your mortgage. So if you can find another role that might pay a little bit higher, or talk to your boss about just a little bit more income to get you to where you want, then you'll be surprised how far it can go as a pay rise.
What about things like side hustles? If you're doing something like Uber Eats or tutoring or whatever, does that count?
Well, it counts in the way that if you're making profit on your side hustle, let's assume that you are building up your deposit. But as we spoke about for the contractors, you need to show 2 years. It's essentially self-employment, whether it's you're earning $1,000 a year or $40,000 a year. You need to show your income over a long space of time, which is kind of a funny thing, right? Because if you're an Uber driver, you're not having to fight for client. You're not having to show that you've got clients. It's you just need to show that you've been turning up to work. But at the end of the day, they can't make an exception for some self-employed and others. So typically, a side hustle will build up your deposit a lot quicker because the money all goes to your deposit. But for income proof, you really want about 12 months, probably more 24 months proof of that steady income flowing in.
Oh, these are such good tips. All right. We've covered most of the things you can do to look better and then the things you can cut to not look as bad. Are there any that we've missed?
I mean, I think really just those easy to get credit applications that you get, where you can quickly get $200. Now, some of the banks deal with it differently. Some of the banks will say, well, that will be ongoing because you've got it once, or you've had it 5 or 6 times or something, and so you're probably going to keep going with that, even though it's about to be paid off. Those loans you can apply for online, you just got to really watch out for those. They really affect your mortgage character as much as the ability to borrow, more than you think they do. They add to your credit reports, all of those kind of, well, actually those micropayments don't, but the online application for loans do. But yeah, you just got to really watch it. Stay squeaky clean. If you are looking at buying a house soon, stay squeaky clean, stay away from those temptations. I will just also say, if you're using your KiwiSaver, we're in a funny place in the world at the moment in terms of investment, and what's going on and overseas and things. Just consider, if you think you're going to be buying in the next 6 months, consider putting your KiwiSaver into a less risky fund,
Conservative or something.
Yeah, I mean, don't just do it because I've said it. Go and talk to someone about your personal
Talk
situation.
to your KiwiSaver provider.
Yeah,
that's what
absolutely.
you pay them for.
Yeah, that's right. Yeah. So, but do think about it, because you don't want to have $80,000 in your credit card and in your KiwiSaver when you go to apply, turn up and you've only got 72,000 because something weird's happened in the overseas markets or something. So think about conservative if you are going to buy in the near future, and by near future I mean 6 months.
Yeah, absolutely. And yeah, like I said, talk to your KiwiSaver provider. You pay them fees, and actually, depending on your fund, some of those funds charge a lot of fees. I mean, that's a cooking the books topic for another day, because I strongly believe in low fees. But you are paying them no matter what, and part of that is they are meant to communicate with you about your options, walk you through them, and they can talk to you about your personal situation. So email them, call them, whatever. They have a duty to you. They absolutely do. Now, I think on this bank stuff, I mean, this is great tips you've given people, and people might be feeling a bit like, ugh, this is a lot of hoops. And I appreciate that, but also I feel like it comes down to the way you think about it is look at it from the bank's point of view. To you, this is your chance for home and stability and to be a homeowner. This is so exciting. You can have a pet, all this stuff. And all of that is totally true, totally valid. But from the bank's point of view, you're an investment, probably a 30-year investment, although I hope that you'll listen to some of the tips on this and maybe you'll be 20 or 15-year investment. But again, that's another podcast. But they're looking at you as a long-term investment. They want to get their money back. So they want to know that you're financially stable, and they also want to make sure they're going to get that money back long-term. So they're looking at, interest rates are at some point going to go up. They want to make sure you're stable. They want to make sure that you're a calm set of hands. I feel like when you look at it that way, as frustrating as some of this might be, it's actually fairly understandable, right?
One of the things I say is, if you were loaning someone $700,000, would you just ask for 3 recent pay slips and the 6 months? I'd ask for their entire world, right, to prove it for 700,000. So it's actually a pretty low bar that they ask for. So yeah, I mean, obviously it's a different when it's a bank, but yeah, it is understandable, and really. Talk to a broker about the responsible lending requirements that the banks have, because sometimes the banks are just as frustrated with some of the funny policies they have to jump through or make you jump through. But it is in the end for everyone's protection to make sure that there's no lending to people who really shouldn't have lending. And sometimes people duck into that kind of category for a funny reason. And you can either explain your way out or try and change your situation. But all of the really quirky policies and some of the frustrating policies are there to protect people. So yeah, we try and talk people through that when we do it, and here's why the bank's asking for that. But at the end of the day, they're just trying to say, are you going to be able to afford this, or is this mortgage going to put you in a situation 5 years down the track when maybe interest rates have risen and things that are going to cause you a stressful sort of financial situation like bankruptcy or something like that. So they're trying to protect you. So to try and work with the banks, they are, I mean, at the end of the day, they want to give you a mortgage if you're a good financial person. So yeah, try and work with them.
Yeah, and it's a little difficult for you to say this, so I'll say it for you. I do think that if someone is a slightly borderline case, whether or not they are in one of those tricky categories, or they've got some money behaviors that they don't understand that are working against them and they could change those behaviors, I do think talking to a broker can help you if you're in a tricky case, because you can explain things often more than a bank will, and help people get ready before they approach the bank. And just tidying up some of those things can make a huge difference, eh?
Yeah, that's right. I mean, typically we do get a few of the more of the borderline applications, and yeah, that's exactly what we do. It's such a great journey when they finally get there and they get into their new home. So it is a really great thing. But yeah, talk to someone. It doesn't matter if you're 2 years away. Get advice now, because it might be that the policy are due to change or have recently changed. And it might be you're only 6 months away now. So well worth talking to someone.
Yeah. And you don't have to have any financial commitment just to have a chat. You can always talk about
right.
When we're ready, what should we look like? And then you come back when you are ready. All right. Well, hey, thank you so much. That's Rupert Goff from Mortgage Lab. Now, if you have questions about this episode or other things you want us to cover in the future, do get in touch. I know a lot of people are struggling on the housing issue right now, so I'm going to do a few episodes. So send me those questions and I will try to get them answered for you in a future podcast. You can find me on Facebook, Frances Cook Journalist, Twitter, Frances Cook, Instagram, Frances Cook NZ. Just pick your favorites, send through those questions. You can also subscribe to Cooking the Books so that you never miss an episode everywhere you find podcasts, including iHeartRadio, Spotify, and Apple Podcasts. Until next time, have a great day.